Hi,
Hi,
welcome
welcome
to
to.
another Zerodha Educate webinar series. This time it's on bonds. In this three-part series, we talk about what bonds are, how they work, and how you can go about investing in them. Today we have with us Winston Noronha, Director of IDFC Mutual Fund. He has an experience of over 25 years in the financial services industry with a background in financial advisory, sales, and research. He has held strategic and leadership roles in these areas. Over to you, Winston.
Uh, Thank you, Hanan. I'm going to give you a small introduction into our program. Uh, this is under series Learning Briefcase. Here in Learning Briefcase, we look at how to we can add value to our investors. And the program we're going to do today is on bonds. Okay, what is a bond basically? When we look at bonds, the question is bonds are a derivative of debt. What is debt? Debt is primarily an exchange of money between two individuals or groups. This debt can take on various forms. It can take the form of short term or long term. One group, which we'll call the fund surplus group, lends to somebody whose funds scarce. Obviously, this is not a one-sided transaction. This transaction involves some repayment of the funds as well as interest and dividend at the period's end. This is in a small snippet of what a debt funds are. Debt basically is only a transaction where money is exchanged, and on behalf of or on in lieu of the money being exchanged, you pay back in interest or a dividend. Now, who is this market of for this money? Who manages? Who's the fund surplus and who's the fund deficit? When we look at the market for the money, there is what we call unorganized money markets. These are unregulated intermediaries. This could be ingenious bankers, money lenders. This could be your father, mother, or your relative who lends you money. Now, the reason we're calling this unorganized is because there are no set markers for this. There are no set requirements for a person to be a borrower or a lender. There is no set interest rates. There are no set uh, features of a product here. It could be open ended. On the other hand, there's what we call the organized markets. Now, the organized markets are built into two parts. There is the short term organized markets and long term organized markets. The short term organized markets are normally called money markets. These are markets where most of the transactions happen with corporates, banks, and institutions. They have fancy names, things like repo, reverse repo, call money, treasuries, cash management bills, certificate of deposits, commercial papers. But what sets out these short-term unorganized markets is that most of it is kind of regulated, and the regulatory entity in most of these cases is either the Reserve Bank of India or the person borrowing or the borrower manages this borrowing at the back end. On the other hand, there are organized long-term debt markets. Uh, there are central banks, central government who needs money. Now, why does the central government need money? They need money to fund their budgets. There are state governments who need money. These are the monies required similarly to fund state budgets or state enterprises. There are corporate debt funds taken by corporate banks, sometimes corporate entities, which are PSU or private sector. There are other special securities, things like what we call SPVs, which are special purpose vehicles wherein for a particular project funds are taken, and there's an escrow account built around it where the interests are paid out of revenues earned from that SPV. Uh, but for the context of today, we'll stick to a few participants and products in the debt markets. Things like central governments. These are dated securities. Now, I've given you the borrower. Who are the investors? When we look at central governments, uh, In fact, everybody can be an investor with the central government. You can invest to an RBI relief bond. Banks can invest to government securities, insurance companies, and mutual funds. Similarly, these are long-term dated securities. When you call dated, it means long-term in nature. On the other hand, there is a short-term securities, things like T-bills, a similar investor profile. State government securities, similar investment profile. PSU banks, PSU companies, banks sometimes issue bonds. Now you'll notice there's a change in the semantics of how debt is nomenclatured for central governments, state governments, and PSUs. When governments borrow, they are called government securities. When PSUs or private companies borrow, they are called bonds. Corporates borrow through debentures. CPs are papers which are short term in nature and issued by corporates. Just like you go to a bank and issue a fixed deposit, similarly, when corporates invest with a bank, they invest through what they call certificate of deposits. Now, what's the big difference between short term and long term? Uh, when we consider long term papers are normally papers which are issued for more than a year. That's why they're called dated. Short term, on the other hand, tend to be papers which are or securities which are issued less than a year. Uh, there's also a payment mechanism. When I say a payment mechanism, is how the interests as well as well as fixed principles are paid. In the case of long-term papers, normally interest are paid at a regular time interval. This could be half yearly, quarterly, yearly. In the case of debt instruments which are short term in nature, however, the outlook is a little different because there is a cost involved in issuing interest separate from the principal. What normally happens is the interest and the principal are both paid together at maturity, which means you could invest 100 rupees today, and at the end of maturity, which was probably within a year or 91 days, you get not only the 100 rupees but also the interest committed on that. uh, there's a little bit of twist here, which for example T-bills use, which is what we call discounted rate. What it means is, imagine that a T-bill gets paid after a year and the coupon on that T-bill is 6%. What will happen is, the T-bill will be issued at 94 rupees, and on maturity, the investor gets 100 rupees. These are called discounting mechanisms of paying interest. So let me reiterate. We have different types of instruments. We have different types of borrowers, and we have different types of lenders. When we speak about debt markets, what we are speaking about is this connection between borrowers and lenders. This connection between borrower and lenders happen in a formal marketplace. Uh, when we talk about debt markets, it is this formal marketplace which we are going to talk about. Today specifically, we are going to talk about a little longer dated papers. When we say longer dated papers, papers which have a little longer maturity. Now, when we look at this, you should look at what is fixed income and why is it called fixed income. Fixed income, and most of us can understand, comes from a notion that what you get is fixed. What is this fixed? So when we look at a bond or a fixed deposit, what you know is that there is a known maturity. Known maturity means you will get the money after a period of time. So as an investor, you will get the money after a period of time. You know what you're investing for, what time period you're investing for. This is called tenure. You also know right up front what is the committed returns you are expected to get. You are going to at the time of negotiation or at time of investing, you know that there is a fixed rate of return committed, and that's what you will get. This known return is called coupon. There's also a known maturity value. A known maturity value in the case of a bond which has more than a year maturity is normally the fixed principal which you've paid. This is called principal. Now, in some cases, the principal could be higher than the face value invested, which is because it is issued at a discounted face value, like we used this example of a short dated paper. Now, fixed income as the nature of fixed income ensures that this is what you get. You get a fixed tenure, you get a fixed coupon, you get a fixed principal. Question, especially on coupon. Why should we get coupon and what determines the rate of coupon? When you look at coupon, the question is, how does somebody set around this rate of coupon? How is this interest rate set out in the market? I like to present before you a formula. The formula is pretty simple. It is small I is equal to big I plus R. I want to do a little thought experiment here, and the idea behind doing this thought experiment is just imagine that you have some money which you want to lend or you want to invest. The question should be, what is the minimum expectation you'll want from this money? What is this minimum expectation what you want for money? Uh, there are two options in front of you. You could lend this money out, or you can invest this money, or you could keep it under your mattress and say it is safe. However, 100 rupees put under the mattress today and 100 rupees after a year is not the same. The reason is, though that 100 rupees which you put underneath your mattress has lost value in the next 1 year. That loss of value is equal to inflation. So when I look at coupon, what most investors are looking for is that this coupon should at least beat inflation, which means that it makes sense that you do not keep your money under the mattress or not invested, but try to beat inflation and invest in a place where there's inflation. So what I'm saying is that there is a lower threshold beyond which you will not lend. What is the R then? The R is that sense of real return, the real rate of return, which is over and above this inflation. Uh, it depends on the kind of risk you take. Okay, so reiterating, coupon, the expectation of investors' coupon is based on what is the inflation is there in the market. Let's take this a little further. We know that inflation is cyclical. A year back, inflation was high, today it is low, and it may probably be going up a little later. But what we've noticed in the last 25 years that inflation in Indian markets tend to be cyclical. Uh, I've kind of given a very simple semantic here of inflation, but let's take this example. The question is, if you use the past example saying that, if there is inflation and you have money to invest, your worst expectation is that you should get inflation adjusted returns, which means you should get inflation minimal and you should be happy with that. However, that is not so. When inflation falls beyond below a particular point, people tend to be wary and are not completely comfortable with getting inflation. So when inflation is at, let's say, at 2% or 3%, people are not really comfortable giving money at 2% or 3% per annum. On the other hand, at the upper reaches of inflation, when inflation is at 10% or 12%, the borrower doesn't want to give money at 10% or 11% or thereabout. Which means there is a band within which inflation will move. A lot of it is based on the fact that people somehow intuitively know that inflation is not stable across continuously, but they move uh, between between ups and downs. uh, they then don't look at inflation as a number that changes every day, but as average inflation over a period of time. In the case of India, most investors expect an average inflation of close to about 7%, and they're comfortable with any returns over and above it. It doesn't mean that when inflation goes down, they are not comfortable with a return less than 7%, because sometimes there are no options. Now, this gives you a unique situation wherein the interest rates on the top are capped at a particular rate, and the interest rates at the bottom are have a floor at a particular rate. Imagine an investor who comes in with an uh, investing with of a fixed tenure, and he says, I am comfortable with where the inflation is. I'm comfortable with the rate of return. And as we look at it, we see that as we go forward, a short-term investment, uh, which is 3 years or thereabout, uh, can be fixed at a particular rate. As the time period, as we come closer to the end of time period and inflations drop, you know, so do your rate of return. And at a lower inflation rate, you plane out at a different fixed coupon. uh, you can see from the graph that based on where the inflation is, interest rates do move cyclically. It moves cyclically downwards as well as upwards. However, it doesn't have that planar line as an inflation, but tends to be held on for a long period of time. This is an important insight for investors, wherein as your interest rates go down, you see your fixed income giving you lower returns, but as the inflation goes up, the fixed income gives you higher returns. Uh, when we look at a bond itself, a bond is a very simple structure. It has a face value of 100, it got a purchase price and a maturity date, and you get coupons which are given every year. Uh, this is the main structure of a bond. However, let's look at what happens when interest rate changes for a bond. In this particular example, I have given you an example of purchasing a bond which giving you 10 rupees coupon every year, which means you get 10 rupees first year, second year, third year, fourth year, and 110 rupees, which is the principal and the coupon given to you at the end. Now, I'm going to do a little twist. I want to sell this bond. I want to sell this bond, but right now, when I sell this bond, because I'm going to make 150 rupees in the full year in the bond, the interest rates in the market have moved to 11%. What does that mean? That means that there is a similar bond available in the market at 11%. Now, a purchase of this bond will look at this and say, if I buy your bond at a 100 rupee price, I'm actually making a 1 rupee loss, notional loss over the next 5 years. Technically, I will make a 5 rupee loss if I buy your bond. I need to buy it at a cheaper rate, which is 95 rupees. On the other hand, if the interest rates fell and you get 9 rupees, you now are in a position to sell the bond because you get a premium of 1 rupee over the next 5 years. What you do is you amortize this 1 rupee upfront. Okay, you can now make plus 5. In fact, you can sell this bond at 105 rupees. This is the feature of making a bond tradable. What you just seen is that when we looked at fixed income, we looked at fixed income and said there are fixed coupon, fixed tenure, fixed maturity, fixed fixed principal. However, when you get a debt market and we get a market for bonds, suddenly based on the where the interest rates are, some of it driven by inflation, you see that there's a potential to not only look at interest rates going up and down, but your capital itself, if because it's tradable, changes nature. In fact, a bond, because it starts trading, suddenly changes nature. Your face value or principal becomes price. Your coupon becomes yield, and your tenure becomes maturity. You've taken a fixed income security and made it in some senses variable. You made it a price, yield, and maturity. This has many effects on the way we look at bonds. This is the core feature of debt funds. The core feature of debt funds is that it doesn't just give you interest and coupon, which most investors think of when they think about fixed, but it brings an added dynamic of different sources of revenue. There is, of course, the existing interest income, but because of market cyclicalities, there is now potential to make gains as well as losses. You've now got a bond which is mark to market. When we look at investing, especially in debt funds or debt bonds, and we make a debt fund or a debt bond tradable, this is the two aspects of investing we should look at. Not just what's happening to interest rates and what's happening to income, but also because of these changes in interest rates, what's happening to my price of the bond, and am I making money or losing money? I'd like to close my session for debt funds today at this conjuncture. Uh, we will discuss more about this in the coming two sessions. But at this juncture, I'd like to reiterate what I just went through. First, there is a surplus part of the economy and there's a deficit part of the economy. Most debt transaction is this movement of money from surplus to deficit. There's a trade-off for this. Obviously, the person borrowing the money pays interest with a fixed expectation that you will pay back the principal a little later. This is the core thesis of fixed income. Fixed income means fixed tenure, fixed coupon, fixed principal. However, uh, life is not so simple. There are different kinds of borrowers. There are different kinds of instruments. The kinds of borrowers set the expectation of returns. When you give money to the government, your expectations of returns are a little lower. However, when you take more riskier bets, your expectation of returns are a little higher. There are short-term instruments and long-term instruments. Short-term instruments are basically instruments which are 1 year and below. Long-term instruments are 1 year and above. Uh, Other than that, we understand that interest rates are cyclical. And because they are cyclical, though we don't see it, as interest rates being cyclical, what tends to happen is that a fixed income security itself has a nature of being cyclical. It depends where in the market cycle you enter, and your rates get fixed at that point in time. However, you can avoid this nature of cyclicality by buying bonds which are tradable. By buying bonds which are tradable, however, you expose yourself to mark-to-market risks. This is what we call capital gains in equity markets. As the stock price rise, you make capital gains. As stock price fall, you make capital losses. In the case of bond funds or bonds, when interest rates rise, you tend to lose capital gains. When interest rate falls, you tend to make capital gains. Uh, if you look at the income portion, on the other hand, it doesn't mean that when you make capital gains, you lose income. Income continues to remain. What you see is an income plus capital gains. On the other hand, when you lose capital gain, it's income minus capital loss, and that's your net return from debt. Thank you for a patient listening. I'm open to questions.
Great, Vincent. Thank you for sharing your knowledge with us. I think the presentation, the PPT was quite interesting, and I learned quite a bit on this session. So, so coming to the questions that have been raised by our audience and some other people at work. So, I'd like to ask you some basic questions. So, the most basic question is, I mean, like, there is equity, there is mutual funds, and all of these things are there which always are promising me more returns. So why should I invest in bonds?
Uh, the dichotomy here is
Hmm.
that information is available everywhere. The markets and platforms are open for to you to trade. When we look at mutual funds, what mutual funds give is this professionalism which comes from the fund managers we have. It is not simple. I kind of try to simplify this this great complexity of saying, what is going to happen to interest rates by saying, if you can predict what's going to happen to inflation, you can know what's going to happen to interest rates. Trust me, it's difficult. That's why we have economists, we have fund managers, we have people who have spent years in this trying to analyze what the government is going to do, what's going to be our fiscal deficit, what's going to be our borrowing calendar, what's going to be the amount we are going to see coming in because of GDP growth. It is a conjunction of all of this that kind of makes this prediction of whether interest rates are going to go up or going to go down. Finally, that's what you want to do. It's similar like equity. You want to know whether interest rates are going to go up, or the stock market is going to go up or going to go down, and take a call on that. The reason you should be investing in debt mutual funds is this professionalism and professional, expertise which we bring to the table, and that's as simple as I can make it. Other than that, it's flexible. It gives you an option to invest in many options. Whether you want a short term, long term, medium term, would you want to do invest it in government securities? You want to invest in corporate bonds? You don't have to go out anywhere. Approach mutual fund, and we've got products that fit into these baskets.
Great. That answer brings me to my next question. Now, given that there are so many options available, can you give some pointers, like, about how to, how one goes about, choosing the categories, and, broadly speaking, how does one go about deciding what kind of,
Oh,
investment you do?
yes, of course, that's very, very simple. It depends on your time horizon. What we normally tell most investors is that look at how long you want to invest. In the case of debt funds, you want to invest, let's say, for a period of 1 year, 2 year, 3 year, 5 years. That's your optionalities. Okay, there are different types of funds. There's a liquid fund which you can invest money for a on a on a daily basis. In the sense, when I say daily, you can invest your money today and remove it out tomorrow. Obviously, when we looked at this example of two portions of income, there's interest income and mark to market income. You don't want to have a lot of mark to market investments in that. So you want to go into investments which are short term in nature, or the product which is invest primarily in nature, we investments which are short term in nature. It's not exposed to markets. On the other hand, there is products which have a high mark to market exposure, products like GSEC funds, or products which are longer dated paper. I used this example previously of this 10. You make 5 rupees. Imagine if this 5 year paper was 10 years. Now, the range would be much higher, isn't it? Instead of getting 5 rupees, you could get 10 rupees. But on the other hand, if you lose 5 rupees, you lose. If you lose money, you lose 10 rupees. So it is a context. However, what we tend to give as a recommendation is shorter term, go for liquid funds. There's a short term basket of funds. There's a medium term basket of funds, and there is a long term bond funds. Now, each of them have different names. They are called liquid funds or cash funds. Then there is a short term pack. There is medium term corporate bond funds, and then there's GSEC funds. Okay, obviously, all of them have different risk profiles. All of them have different uh, internal securities which they hold.
Great. Thanks so much for that information. So, one of the things which I have experienced while I deal with a lot of first-time customers, and they like to know about, what kind of investments they have to make. So, we've been advocating that bonds are probably the safest investment you could ever make. But having said that, what kind of risks do you think the bond markets have for investors?
Uh, I like to caveat that when I say they are safest, there are different types of bonds. When you give your money to the government, just because they are the government and they have the ability to print more money, it is the safest investment there is. On the other hand, you could give money to me. uh, I would obviously not be as safe, isn't it? But you would ask for your pound of flesh, so to say. Let me go back to this formula of I is equal to I plus R. That risk which you talk about isn't that real rate. Most government investing, money which you give to the government or through RBI relief bonds, or for example even bank fixed deposit, because if they are pseudo government, would just give you inflation. When you try to go for a higher rate of return, with that comes with it comes real risk. The risk can have different connotations. It could have connotation like credit risk. Uh, you may not get your money back, or there could be liquidity risk, in the sense that there's this corporate or a mutual fund who has bought this bond, but it's not tradable. You want the money immediately, but it's not tradable, so they may have to sell it at a discount. There's also interest rate risks. When interest rates go up, you make a capital loss. On the other hand, when interest rates go down, you make capital gains. So there is a whole range of returns. But if you want to be safe, just stick to liquid funds. If you want to take a little more risk, go with short-term funds. For those who are looking at really safe returns, this is the baskets which they should stick to.
Okay, great. So, you are a professional from the industry, so you would be well informed about bonds and all other types of investments which are available. Now, for a newbie or someone who's not even aware of this, so stock markets, I think people get more information about mutual funds. I guess everybody, even my mom, will know about mutual funds. But for bonds, like these kind of debt bonds, like what kind of platforms are available for people to trade? What kind of knowledge is available for people to go and learn? Like after having heard this presentation from you, what kind of knowledge can they, where can they go seek additional knowledge, and where, what other than Zerodha, what kind of platform exists for them to make these kind of trades?
So the government has NSE open market. I think so. There's an open market for bonds on National Stock Exchange. You can even trade bonds there. I mean, it's you could do that yourself. On the other hand, if you want to know more, it's basically Google. I mean, you could go to Investopedia. You could go to NSE. NSE has a wholesale market platform, WDM, which is basically it's called wholesale debt market platform, where they explain a lot of this. It could be a little daunting for people who are first going into it, but as you kind of learn more about it, it becomes a lot more simpler. My context of doing the program here is that let it not daunt you. I mean, imagine 80% of the investors today invest in a fixed income security. What we are saying is that you've just taken a fixed income security and made it tradable, and because of this trade you get all these complexities. If you are just a buy and hold investor, the best way to look at it is, would you give the person this money? Second, how long are you going to give the money? And thirdly, what is the rate of return you get? This is as simple as it gets. You could dive down into complexities. The first starting point is wait for the first of February. You'll get the budget. The budget gives you the government's fiscal deficit. The government's fiscal deficit decides the amount of money the government needs to borrow. Correct? If the government's borrowing goes up
Mhm.
because fiscal deficit is increased, you automatically know interest rates over the next year will tend to go up. Simplified. I'm really simplifying it, but sometimes it's just commonsensical. You could approach this in a commonsensical way, and if you're really looking at being a trader on this, there are options.
All right. All right. And I mean, your presentation covered pretty much everything, but there's two more sessions. So I don't want to bother you with too many questions. There's one last question,
Yeah.
which I think you've already answered it through the presentation, but it's nice to end it with that. So what I'd like to know is, if I intend to hold a bond till maturity,
Yeah.
will it affect my returns if based on the changes that might happen?
Uh, Let me go back. You know, this happens, correct?
Hmm.
If you look at a bond, what is a bond? It's a purchase price and a commitment to pay you a fixed income at the end, fixed after a fixed period, and you get a fixed income. Now, what will tend to happen is there are cycles in the middle. Your income, assuming the bond doesn't default, your income continues to accrue to you. At the end, when the bond matures, that's all you will get. In the meantime, however, you could have cycles where prices go up and prices go down. I'd like to end with a quote which is normally, uh, famously used in equity markets. It says, in the end, long-term prices of stock securities tend to follow EPS. Okay, nothing different in bonds.
Okay. Okay, great. Thanks so much for that, Winston. And
Thank you,
I
Anand.
look forward to hosting you again the next time around and learn more from you. Thanks for your time and your patience with us.
Thank you. You're welcome.
Have a nice day. Yeah.
Yeah.
Bye bye.